Have you ever stopped to ask yourself a strange question? Banks do not manufacture cars. They do not grow food. They do not build the houses you live in. And yet, year after year, they make enormous amounts of money. While ordinary companies must design products, manage inventory, hire workers, and convince customers to buy something, banks operate through a very different model. In 2025, FDIC-insured institutions reported nearly $296 billion in net income. A major driver was net interest income, the difference between what financial institutions earn from lending money and what it costs them to obtain that money. This is not a conspiracy, it is the business model. Banks take deposits, obtain funding, provide loans, charge interest, collect fees, and earn money from financial transactions. But there is one type of customer who becomes much harder to profit from through expensive consumer debt: the customer who does not desperately need to borrow. And for many Americans, the game begins to change when they have around $25,000 saved. Now, let us make something clear. The bank does not literally hate your $25,000. In fact, banks generally want deposits. What changes is your behavior. Once you have enough money to absorb emergencies, you stop revolving credit card balances. You stop using overdraft to survive until payday. You stop accepting the first loan offered to you. You stop financing every unexpected expense. And that makes you less profitable to the most expensive parts of the consumer credit system. To understand why, imagine two workers. They live in the same city. They earn similar salaries. They pay similar rent and have similar monthly expenses. The first worker has almost nothing saved. Every paycheck arrives already carrying a list of obligations: rent, insurance, groceries, a car payment, credit card minimums, subscriptions, student loans. By the end of the month, the account is nearly empty. Then, one morning, the car stops working. The repair costs $1,500. What can this person do? They can place it on a credit card. They can use a buy now, pay later service. They can ask for a personal loan. They can delay another bill. They can carry the balance and hope next month is easier. But next month is rarely easier because the original expense has now become an expense plus interest. In 2024, the average APR reached 25.2% on general-purpose credit cards, while the average APR on newly opened general-purpose accounts reached 27.5%. At those rates, a temporary emergency can become a long-term payment. The second worker earns the same amount, but this person has $25,000 saved. When the car breaks, the situation is frustrating, but it is not a financial disaster. The repair is paid without carrying a high-interest balance. There is time to compare mechanics. There is time to question the estimate. There is no need to accept the first financing offer because the car must be fixed immediately. The first worker is negotiating from desperation. The second is negotiating from stability. That difference is more powerful than it appears. A large part of the financial system makes money from urgency. When you need an answer today, you cannot always wait for a better rate. When you need the car to get to work tomorrow, you may accept expensive financing. When the rent is due and your account is empty, an overdraft fee can feel better than missing the payment. When you have no reserve, almost every financial decision becomes a decision about survival, and expensive choices begin to look reasonable. This is not a rare situation. According to the Federal Reserve, only 63% of American adults said they could cover a $400 emergency using cash or its equivalent. Among those who could not, carrying a credit card balance was the most common alternative. 13% said they could not cover the expense by any method. That means $25,000 is not just a number inside an account. It represents distance. Distance between you and a high-interest credit card. Distance between you and an emergency loan. Distance between you and being forced to make a terrible decision quickly. And the system becomes much less powerful when you are no longer forced to participate in its most expensive products. Consider what happens when someone without savings loses a job. The clock begins immediately. Every day without income increases the pressure. The person may accept the first offer available, even if the salary is lower, the conditions are worse, or the commute is unreasonable. They cannot afford to wait. Now give that same person several months of essential expenses. They still need another job, but they do not need to accept the first bad offer placed in front of them. They can negotiate. They can search more carefully. They may be able to complete a certification, move to another city, or change industries. Savings do not remove the problem. They change the position from which the problem is solved. There is a basic principle in negotiation. The person with the most power is often the person who can walk away. If you desperately need the loan, the lender controls the conversation. If you desperately need the job, the employer controls the conversation. If you desperately need the purchase today, the seller controls the conversation. But when you have time and liquidity, you can say no. And no may be the most valuable word your savings can buy. This is also why your credit score and your financial independence are not the same thing. A credit score is designed to predict your credit behavior, including how likely you are to repay borrowed money. It considers factors such as payment history, unpaid debt, credit utilization, account history, and recent applications. It is not designed to measure your net worth, freedom, or emergency savings. You can have an excellent credit score and still be trapped by monthly payments. You can look financially successful while having no real breathing room. And you do not need to carry a credit card balance or pay interest to build a good credit history. Paying on time and keeping balances low are what matter. $25,000 also changes your relationship with opportunity. Imagine that a valuable professional course becomes available. A necessary tool for your work is being sold at a reasonable price. A move could increase your income. A temporary reduction in working hours would give you time to build a business or develop a new skill. Someone without savings must often reject these opportunities. Not because the opportunity is bad, because all available money is already committed to staying alive. Savings give you the ability to think beyond the next bill. This does not mean everyone with $25,000 should start making large purchases or taking risks. That would destroy the entire advantage. The money is powerful precisely because it does not need to be used immediately. It gives you options. It protects you from debt. It gives you time. It lowers the price of urgency. And it allows you to make decisions based on value instead of fear. But is $25,000 the correct emergency fund for everyone? No. Someone supporting a family in an expensive city may need much more. Someone with low essential expenses and stable employment may need less. The real target should be connected to your necessary monthly expenses, income stability, insurance coverage, family responsibilities, and personal risks. In 2024, 55% of American adults said they had enough emergency savings to cover 3 months of expenses. 30% said they could not cover 3 months by any method. So $25,000 is not a magical number. It is a symbol of a larger transition. The moment when an unexpected expense stops becoming an automatic debt. The moment when losing a job stops becoming an immediate catastrophe. The moment when a pre-approved credit offer stops feeling like rescue. The moment when you stop asking, "How much will the bank allow me to borrow?" and begin asking, "Is borrowing actually the best decision for me?" That is when the relationship changes. Before the reserve, the bank can be your emergency plan. After the reserve, the bank becomes only a financial service you may or may not choose to use. You can still use a credit card. You can still build a credit history. You can still take a responsible loan when the numbers make sense. But you are choosing those products. You are not being forced into them by an empty account. That distinction is everything. The goal is not to become afraid of banks. Banks provide useful services. The goal is to understand exactly where the system makes money and to stop donating money through avoidable interest and fees. Begin by calculating your essential monthly expenses, not your ideal lifestyle, not every subscription or luxury, the amount required to keep housing, food, transportation, insurance, and essential obligations functioning. Then build the first layer, $1,000, then 1 month of essential expenses, then several months. Automate the transfer so that saving does not depend on making the correct emotional decision every payday. Keep emergency money accessible and separated from everyday spending. And once the emergency reserve is strong enough for your situation, money intended for longer-term goals can be given a different job. No overnight miracle, no secret system, just a gradual change in who has the leverage. $25,000 will not make you wealthy. It will not buy complete freedom, and it will not solve every financial problem. But it can buy breathing room. It can protect you from some of the most expensive forms of debt. It can prevent one repair, medical bill, or interrupted paycheck from destroying years of progress. Most importantly, it can change who you become. Because someone who learns to build a real reserve learns several things at the same time: how to delay gratification, how to live below their income, how to automate good decisions, how to separate needs from impulses, how to stop treating available credit as available money. And someone who learns those lessons rarely sees money the same way again. So the greatest threat to the expensive side of consumer banking is not that you suddenly become a millionaire. It is that you stop being desperate, because desperate customers accept terrible terms. Prepared customers compare. Desperate customers focus on the monthly payment. Prepared customers calculate the total cost. Desperate customers ask whether they will be approved. Prepared customers ask whether the deal is worth accepting. Build your reserve. Use banks as tools. Pay credit cards in full whenever possible. Avoid borrowing for emergencies that savings could cover. And remember, the bank does not fear the money sitting in your account. It fears the moment you realize you no longer need expensive debt to survive. If this video changed how you see emergency savings, like the video and subscribe to the channel. And write this in the comments: I am building my leverage. Because the goal is not simply to become rich. The goal is to become difficult to control.